Ladies and gentlemen, if all you saw today was a price on a screen, then you missed the event entirely. You stared at the number, but you ignored the signal. You watched the scoreboard while the stadium itself caught fire. Because what happened today was never about whether silver traded at $79 or $80. The real story was not a candle, not a chart pattern, not a technical level. The real story was a name, and that name carries more weight than any price print you will ever see. Elon Musk. While traders argued over pennies and algorithms fought microseconds, the most powerful industrial buyer on the planet did something far more important. He spoke. Not in a press release, not through a hedge fund, but in 4 simple words posted publicly for the world to see. This is not good. To an untrained eye that looks harmless, almost casual. But markets are not moved by words. They are moved by who says them. This was not a media pundit fishing for attention. This was not a fund manager talking his book. This was the CEO of Tesla SpaceX and the largest integrated solar operation on Earth. A man whose entire industrial empire runs on one irreplaceable input: silver, the most electrically conductive metal known to physics. The metal without which electric vehicles fail, solar panels underperform, and advanced electronics simply do not exist. When Elon Musk says this is not good, he is not talking about price. Price is irrelevant to him. He has liquidity, he has capital. What he does not have is infinite access to physical metal. Availability is the issue. Supply is the issue. And supply, once broken, does not respond to money. It responds to geology, logistics, and time. This is the moment the narrative changes. For years, silver was treated like a financial toy, a paper battlefield between longs and shorts. That war ended today, because as of this moment, silver is no longer a speculative asset. It is a survival asset. The financial war is over. The industrial war has begun. If this framing already changed how you see the market, make sure you subscribe to the channel and comment 1 if you are starting to see the signal behind the price, or 2 if you are still watching the scoreboard. Type 1 to continue to Chapter 2. Type 2 to stop here. To understand why those 4 words matter, you need to understand something most traders never do. Industrial buyers do not play the same game as financial speculators. A hedge fund can close a position with a mouse click. A market maker can roll a contract. A bank can cash settle and walk away bruised but alive. An industrial giant does not have that luxury. They cannot substitute spreadsheets for atoms. Tesla cannot manufacture an electric vehicle without silver. SpaceX cannot build advanced avionics without silver. High-efficiency solar panels cannot exist without silver paste. This is not an opinion, it is physics. Conductivity is not negotiable. When supply tightens, industrial, users are not bullish or bearish, they are exposed. And this is where this misunderstanding begins. When people say Elon Musk is worried about silver prices, they reveal they do not understand his problem at all. He is not long silver. He is short it, deeply short it. Every car sold, every battery installed, every panel deployed creates a future obligation for physical metal that must be delivered, not paid away. Banks can lose money and survive. Factories lose metal and shut down. If a bullion bank is short silver and the price spikes, they wire cash and move on. If Tesla is short silver and supply disappears, production halts, revenues stop, stock prices collapse, empires wobble. That is the asymmetry that matters. This is why Musk's statement was not commentary. It was a warning shot. He was signaling to every other industrial CEO that the era of trust is over. Just-in-time inventory only works when supply chains are honest and liquid. When shelves go empty just in time becomes not in time. And when that happens, the behavior of buyers changes instantly. Companies stop optimizing for price. They start optimizing for survival. Orders are doubled, then tripled. Inventory is hoarded, not traded. Metal is pulled forward from the future and locked away. This is how shortages turn into crises, not because of speculation, but because of fear. And once that fear enters the industrial system, no algorithm can stop it. Because this time, the buyers are not betting on charts. They are protecting production lines. The moment industrial fear takes hold, the market stops behaving like a market and starts behaving like a vacuum. This is where most traders get blindsided. They expect gradual moves, orderly repricing, rational pullbacks. That is not how supply shocks work. When survival becomes the objective, price becomes secondary, and liquidity disappears first. Think about what happens next, not on a chart, but inside a boardroom. A procurement officer reads Musk's words and feels their stomach drop. They do not wait for confirmation. They do not wait for CNBC. They pick up the phone. They call their refiner. They say, double our order. Then they pause, and they say, no, triple it, and deliver it to our vault, not yours. Now multiply that behavior across Apple, Samsung, battery manufacturers, defense contractors, and solar giants. This is not coordinated. It does not need to be. Fear is the coordination mechanism. Each buyer knows that whoever hesitates loses access. This is how inventory hoarding cycles begin. Not to make money, but to stay alive. And when industrial giants enter the market this way, prices do not climb politely. They jump. They do not bid up by cents. They sweep order books. Everything at 79 is gone. Everything at 85 disappears. 90 becomes irrelevant. The market does not ask what silver is worth. It asks who still has it. This is why today's move was not a bubble. It was a repricing of reality. Algorithms understand this dynamic better than humans do. They know Musk does not speak casually about supply chains. He has better data than any trader, any analyst, any regulator. If he sees a shortage, it already exists. And here is the dangerous part. Musk is not just an observer in this market. He is a catalyst. History has already shown us what happens when he publicly acknowledges scarcity. When Tesla touched Bitcoin, price doubled in weeks. Now imagine what happens if Tesla decides it cannot trust the market at all. If the next headline is not a tweet but a filing. If Tesla secures direct mining exposure or begins physical stockpiling, that is not bullish. That is structural. At that point, $100 is not a target, it is a floor. Because once industrial demand turns defensive, there is no price ceiling, only availability. What makes this moment truly dangerous is that Musk's concern is not abstract. It is not a long-term theory or a slow-moving trend. It is tied to a specific date, a hard deadline that most of the market is still ignoring. A date that is only days away, January 1st, 2026. On that day, the rules of the silver market change permanently. China, the world's largest refiner and processor of silver, is implementing a new export licensing system. To the casual observer, this sounds like paperwork. In reality, it is a blockade. And blockades are not designed to manage trade. They are designed to control power. We have read the fine print. The requirements are surgical. To export silver out of China, a company must now prove massive annual production capacity and tens of millions of dollars in established credit lines. These thresholds are not arbitrary. They are a guillotine. Hundreds of small and mid-sized refiners, traders, and brokers are instantly disqualified. Overnight, they are cut off from Western buyers. Their metal does not disappear, it stays inside China. It floods domestic supply chains and feeds Chinese manufacturers directly. Solar giants, battery producers, EV champions receive priority access. This is not regulation, it is resource nationalism. The same playbook China used with rare earths is being deployed again, this time with silver. Timing is everything. This policy arrives precisely as the global silver deficit reaches critical mass. As inventories thin, as demand accelerates, China is closing the door just as the building catches fire. Musk sees this clearly. He understands that even silver mined in Mexico or Peru often flows through Chinese refining capacity. When that gate closes, the global supply chain snaps. The world does not lose silver evenly, it splits. One price inside China where metal exists. Another price outside where panic begins. Arbitrage dies, trust evaporates, and Western industry is left fighting for scraps in a market that just lost its largest supplier. This is not theory, this is a deadline, and deadlines change behavior fast. To grasp the scale of what is coming, you need to confront a reality. Wall Street has avoided for years. The silver market was already broken long before China decided to lock the gates. The export controls are not the cause of the crisis, they are the match. The fuel has been piling up for half a decade. For 5 consecutive years, global silver consumption has exceeded global production. This is not a temporary imbalance. It is a structural deficit. In the most recent year alone, demand surged past 1.2 billion ounces, while mining supply stalled barely above 1 billion. The difference did not vanish. It was stolen from the past. That gap was filled by draining above-ground stockpiles, emptying vaults in London and New York, and squeezing recycling flows to their limits. But stockpiles are not mines. They do not regenerate. You can only drain a bathtub until you hit porcelain. And now the scraping has begun. Normally, markets respond to shortages with substitution. Copper replaces aluminum. Palladium replaces platinum. Analysts assume silver will follow the same script. It will not. Silver is not interchangeable. It is singular. It is the most electrically conductive element known to science. No alloy performs as well. No substitute preserves efficiency without compromise. In advanced electronics, solar energy EV battery systems and data infrastructure efficiency is not optional. A small drop in conductivity translates into heat loss failure. Good enough does not win races, and the global economy is racing. This is why industrial demand now consumes more than half of all silver produced. Silver is no longer a precious metal with decorative value. It is a strategic input, the DNA of the energy transition. You cannot electrify the world without consuming staggering amounts of it. When Musk looks at the numbers, he sees the truth. The deficit is not closing, it is widening. And with China's supply about to vanish from Western markets, the math turns lethal. Now we arrive at the most dangerous illusion in the entire financial system. The point where this story stops being about supply and demand and becomes about structure, the paper market. For decades, silver was not priced by miners or manufacturers. It was priced by derivatives. Promises stacked on promises, all built on one assumption. No one would ever ask for the metal at the same time. There is one number that exposes this illusion completely: the paper-to-physical ratio. Right now, for every single ounce of real silver sitting in a registered vault, there are hundreds of paper claims demanding ownership of that same ounce. Picture it clearly. One coin on a table, hundreds of receipts in circulation. For 40 years this worked because the claimants were speculators, hedge funds, traders, algorithms. They flipped paper back and forth and never asked for delivery. The music kept playing, so nobody noticed there was only one chair. But today, the music stopped. Not because of retail investors, but because industrial buyers entered the room. When companies like Tesla, Apple, and Samsung stop wanting exposure and start wanting possession, the system breaks. Paper contracts cannot power factories. Cash settlement cannot build cars. At that moment, the market reveals itself as a fractional reserve illusion, pretending to represent physical reality. When delivery is demanded, only one claimant gets the metal. Everyone else gets a check settled at a price that no longer exists. Currency replaces scarcity. That is how wealth is transferred without headlines or riots. And inventories confirm it. Registered supplies have been draining for years. Buffers are gone, and in some regions, usable silver represents weeks of demand. One surge, one disruption, and shelves go empty. This is not a market approaching failure. It is a system already failing, still pretending it is stable. Once the paper illusion begins to crack, the market splits in two. And this is where most investors get lost, because they keep looking at one price when there are now two realities: the screen price and the street price, the price of promises and the price of metal. In a functioning market, arbitrage keeps these two aligned. If silver is cheaper in New York and more expensive in Shanghai, traders buy low, ship metal, sell high, and close the gap. That mechanism is the gravity of global pricing, but gravity only works when metal is allowed to move, and as of now, it is not. China's export controls severed the artery. Once silver enters China, it does not come back out. Licenses restrict flow, and hoarding replaces trade. Arbitrage is dead, and when arbitrage dies, prices diverge. This is why the Shanghai premium matters more than the COMEX quote. In China, buyers are paying more not because they are irrational, but because they are closer to the manufacturing base. They see the shortages first. They know the order books. They understand the timelines. They are not buying to speculate. They are buying to survive. When you see physical premiums explode, the market is screaming that the spot price is invalid. The screen price assumes infinite supply and cash settlement. The street price reflects scarcity, and scarcity always wins. This divergence is the future bleeding into the present. The higher price in the East is not an anomaly, it is a warning. Western vaults are draining, and once that buffer is gone, the Western price does not drift upward. It snaps. This is why today's price is not expensive. It is discounted. It is priced for a world that no longer exists, and the window to buy at that discount is closing fast. As the divergence accelerates, pressure builds where the system is weakest. Not in Shanghai where metal exists, but in New York and London where promises outnumber ounces. This is where the squeeze becomes violent because every short position in the West just became infinitely more dangerous. In the past, a short seller had an escape route. If delivery pressure rose, they could source metal globally. Call a refiner, ship bars, relieve the stress. That valve is now closed. China was the release mechanism, and it is gone. This turns Western exchanges into isolated islands. When a bank in New York is short silver and faces delivery demands, there is no external supply to save them. They are trapped between margin calls and empty vaults. This is how squeezes go vertical. Not because of speculation, but because there is nowhere to hide. Every paper smash now backfires. When prices are pushed down on screens, physical demand surges. Buyers step in aggressively, draining what little inventory remains. A paper discount in a physical shortage is not suppression. It is a clearance sale on an empty shelf. This is why volatility explodes near the end of a cycle. The market is not unstable because it is emotional. It is unstable because it is lying, and lies collapse suddenly. The Western market is approaching the unobtainable phase. Dealers delay shipments. Premiums widen. Stock disappears without warning. The buy button does not fade out gradually. It vanishes overnight. And when that happens, price discovery ends. The question is no longer how much does silver cost? It becomes who already has it. When scarcity reaches this stage, it stops being a commodity story and becomes a financial one. This is where silver collides with the broader system because silver is not just a metal. Inside the banking world, it is collateral. It is leverage. It is a hidden load-bearing beam in a structure built on confidence. And confidence, once cracked, does not heal on a schedule. It snaps, it spreads, and it infects everything it touches. Bullion banks did not simply sell silver once. They leased it, swapped it, rehypothecated it, and used it to secure borrowing across markets. 1 ounce supported multiple balance sheets. As long as prices stayed contained and delivery was rare, the illusion held. But when metal is demanded, the leverage unwinds all at once, like pulling one pin and watching the whole machine shake. A failure in silver delivery does not stay in the silver pit. It cascades. A bank that cannot meet a margin call loses access to liquidity. Collateral is seized. Other positions are forced closed. Counterparties panic. Lending freezes. This is how a niche market becomes systemic risk, because the plumbing of finance is one interconnected loop. This is why central banks respond the way they do, not because they care about silver, but because they care about survival. When the choice is between allowing a commodity to reprice honestly or preventing a banking seizure, they intervene. Liquidity is injected, losses are socialized, the signal is destroyed. But intervention has consequences. Printing currency to save leverage devalues the unit of account. And when the unit weakens, hard assets rise. Every rescue accelerates the very move it is trying to suppress. This is the trap. The market understands this feedback loop. Heads, scarcity wins, tails, currency loses. Either path pushes silver higher while trust bleeds out quietly in the background. At this point, the downside is capped by physics. The upside is driven by policy. That asymmetry is what defines the final phase. This is where the story stops being about prediction and becomes about positioning. Not tomorrow, not next quarter, but structurally. What we are witnessing is not a rally. It is a reset, a transition from a paper-priced illusion to a physically constrained reality. And once that transition begins, it does not reverse quietly. The strategic lesson is simple but uncomfortable. Price is no longer the primary risk. Access is. In a market where industrial users must secure metal to survive, volatility is noise. Pullbacks are not signals to exit, they are stress tests revealing how broken the system has become. Silver is being repriced from a speculative commodity into a strategic asset. That shift forces the price to rise, not to enrich investors, but to ration demand. High prices are not excess, they are the cure. They slow consumption, stimulate supply, and expose leverage that never should have existed. For the listener, the mistake is thinking this is late. Late was when vaults were full and China was exporting freely. Late was when paper claims were trusted. Today is not late. Today is the transition. And transitions are where the largest asymmetries exist. The disciplined response is not panic. It is clarity. Understand what you own. Understand what is paper and what is real. Do not confuse liquidity with safety. Do not confuse screens with supply. History is clear on one point. When monetary systems strain under leverage, value migrates toward things that cannot be printed, promised,